Good morning, everybody. Welcome to the Flow Show. It's another day with floods of ECB speakers. We've had 18 of them so far in the first 17 days of the year. Don't we love it? Morning, Kay. How you doing, mate? Finished the yield charts?
Good morning, Ryan. Good morning, everybody. Hey, I'll show it, I'll show it for our viewers. I know I never look actually on ticks on yields, but this morning I couldn't resist just to look good in the world of tech wizards,
You go ahead, mate. You go ahead. Yeah, I saw that other note. You'll be doing it by 2030. You'll be doing it for 2030 as well. If I'm still trading here in 2030, something's gone wrong. I hope everyone's doing all right today. Surviving. That's the least we all need to do in this trading world. Let's see how the world is surviving. China's surviving. Q4 GDP came in as Premier Lee suggested, 5.2%. Let's find that for you there. There we go. Q4 GDP 5.2%, which will leave the year to date around 5.2, 5.3%, as well as we've been told, as we said, by Chinese officials, the Premier. Also, other data, industrial production coming in largely better than expected, 6.8% year on year, year to date, 4.6% better than last month. Retail sales a little bit soft, 7.4%, but still a decent growth number. 7.4 there. Year to date as well, a little bit better, 2 pips better, 7.22. Unemployment rate was higher though, 5.1%. Yes, that's a little bit higher there. I did see 5.2% on another calendar, so I don't know what's going on there. Maybe it's been changed, I don't know, but there or thereabouts. It's still worse than last month. Anyway, China has, China's Taiwan Affairs Office has been the first to come out speaking about the election result in Taiwan. It says that election result does not change the fact that Taiwan is part of China. The result cannot stop the trend towards reunification. Compatriots on both sides of the Taiwan Strait are Chinese. And they're willing to create the widest space for peaceful reunification. So not perhaps the blood and thunder comments that we might thought we were going to get from that, talking about peaceful reunification. And those comments probably a little bit weaker than we might have expected in their totality as well. Japan. The big life insurance companies are all coming out with a few comments. For Koku Life Insurance says they are going to wait on the Bank of Japan to scrap negative rates before buying bonds. That follows similar for Meiji Yasuda Life Insurance Company. Now, it can be a situation where these insurance firms, all of these big whales, buy bonds, buy a lot of domestic bonds, and it's noted that they can buy a lot of these bonds in the latter part of the fiscal year. This may present a bit of a problem for the BOJ or for the government when they're issuing bonds if there's not a big take up, because those who usually take them up are going to wait for higher rates before doing so. There's no point buying bonds with low yields now when you can buy them later with higher yields. That's going to be one of the effects from potential tightening from the Bank of Japan. Kay, anything we need to keep an eye on that front?
Yeah, of course. If the big Japanese insurers and pension funds and all of that delay bond buying, it should put a little bit of upward pressure on yields when we see the government trying to fund their packages. On the other hand, though, we know about it because they did announce that after September last year, when they said that they would wait with their bond buying, but already then they added that they would be happy about with yields at around 1% and a little bit higher on the 20s and 30s, which are traditionally, yeah, they do go to the 20s as well, because they traditionally went to really massively into the 10s and then smaller into 20s and 30s. But they did say last year that because of that yield pushing higher last year, that they also went into 20s. But then, so it's a bit of a double-edged sword, yeah. So they may contribute to a bit higher yields when the government needs to fund, but then at the same time they're already saying that they would be happy with 1-year yields around 10-year yields around 1%, which is very low compared to the rest of the world still, right? So
Yeah.
yeah, it's a bit of a double-edged sword, I would say. But yes, it is a possibility that that they are contributing to yields creeping up, especially I would say if we get those February rumors of or confirmations rather, because the rumors we've had them already, of very decent wage hikes. That would of course contribute to those Japanese yields creeping up a bit. Yeah, but the market hasn't traded any of those comments, right? I think everybody's well aware of the plans of those insurers.
Will it be a problem for the government, you know, if these life insurance companies in Wales are big purchasers of JGBs? You know, if the government's issuing a lot, is that going to dent demand if they hold back, or they struggle to
Of
sell
course, it's
more
going
than they need
to
to?
of course it's going to then demand. But then, as we've seen, Bank of Japan has scaled back on the scheduled JGB buying, but they've never said anything about unscheduled. So since there's still a very good cooperation between the Bank of Japan and the government, I suspect that if they don't see enough demand from the regulars, that Bank of Japan will step in and give that liquidity for as long as Ueda hasn't decided to really effectively normalize.
Cool. Thank you very much. There was a Bank of Japan household survey out as well. Japanese households expect inflation to rise by an average of 10% a year from now. The median number is 8%. 79.3% of households expect prices to rise a year from now, and that's compared with 86.8% in the previous survey. So a little bit, quite a significant dip in expectations for prices. On the 5-year basis, they expect an average of 7.6% 5 years from now. The median is 5%, and 76.5% of those households expect prices to rise 5 years from now. That's down also from 80.7% in the prior survey. So although people are seeing higher inflation, less are seeing it, which may be something that the Bank of Japan, or definitely the government, will try to enforce, pushing for more rate hikes. They don't want inflation expectations coming down, or that has a negative effect on them trying to tighten policy. Ali, wait, mate, I'm getting there. I'll get to the UK stuff in a moment. Hold your horses, mate. Riksbank's Bremen says that inflation is falling, but they must be prepared for any setbacks. Obviously, seeing what's going on elsewhere with a slight uptick in inflation. So there's probably no need to raise interest rates anymore. Right, Ali, just for you, UK data. CPI, sticky. Core CPI coming in at 5.1%, was expected to drop 2 pips, came in unchanged. Headline CPI went up a pip, was expected to go down a pip. So pretty similar, as I said, what we've seen in Canada, we've seen it in the Eurozone, we've seen US inflation a bit stickier than expected. There was a bit of a counter to that from the PPI numbers which saw steeper drops. Input PPI down 2.8%. Year on year was only expected down 1.9%. PPI output year on year was up 0.1%, was expected up 0.4%. Retail price year on year, which not many look at outside of the UK, 5.2%, still sticky on that one. So a bit of a pushback from the PPI number suggests that maybe the CPI stuff is a bit temporary, but for the Bank of England, it is sticky, and that's already started to reduce rate cut expectations for the Bank of England, those getting knocked back. It's also meant that the pound is a bit firmer again today. The data is starting to help the pound with its support, shall we say. So we're seeing, as I said, cable looking quite boisterous compared to some of the other pairs, and we'll look at the prices in a moment. I mentioned that it's floodgates on central bank speakers, and the ECB lot have been out. We have had today 1, 2, 3, 4, 5, 6, 7, 8, 9 of them speaking today. 9 speaking today. Can't keep up with it. I'll save Lagarde for last because she had a couple of key comments. ECB's not says that markets are getting ahead of themselves on cuts. A lot must go well to hit the 2% inflation target in 2025, and that if any easing happens, it will be very gradual, and that we need to see a turnaround in wages. Bit of a pushback though. He said the more easing the market does, the less likely we'll cut. ECB's Vasile says my rate expectations are significantly different from the markets. It's absolutely premature to expect a cut at the start of Q2. Labour markets are still strong, and we need caution on wages. He needs to see Q1 inflation and wage data before making any decisions. ECB's Panetta, this inflation is happening. It is strong and will continue. Monetary conditions should adjust, but he's awaiting the data first to confirm the disinflation outlook. He says that banks must be aware it's just a matter of time before they start paying for liquidity. More of the free lunches coming to an end. ECB's Nagel was out yesterday, pretty much repeating her comments with a couple of additions. Says that they will monitor US elections for any market impact. Still have a way to go on inflation, need to wait for the data to decide on policy. Discussion on rate cuts comes too soon. ECB Centeno should definitely avoid undershooting on inflation, and the inflation trajectory is good. Simcus, far less optimistic than markets are about rate cuts. Interest rate cuts may begin around the summer. ECB's Muller, market expectations for 2024 rate cuts are aggressive. Now to Lagarde. She came out and said inflation isn't where the ECB wants, but is confident inflation will reach the 2% target. There is no victory yet. She's also started blaming the market, says that too optimistic markets doesn't help the ECB fight inflation, because they're artificially loosening markets with those rate expectations. That's why she doesn't like what markets are doing. So she's watching wages, profit margins, energy and supply chains, and that second round effects would be a cause for concern. But she says the ECB has reached peak rates short of a major shock. Then there's a bit of a kicker. Last Friday, she said that she can't give any timings for rate cuts. Today, she said it's likely the ECB will cut rates by the summer. So in the space of a few days, she's gone from not wanting to say anything to now telling us when rate cuts will be likely. Now, I've done a little bit of analysis, which I put in our chat room, in our newsroom, for those who are in there want to have a look at it. It's looking like nearly every governing council member is pushing back against any form of early rate cuts. It's looking like towards the end of Q2, beginning of Q3 is the indication of when a lot of them are looking to potentially start deciding about rate cuts, data dependent, of course. That leaves very little time for them to get the amount of cuts the market is suggesting. The market's still looking at 4 to 5 cuts. If we assume that they start cutting in June, which will be a forecast meeting, that gives them that meeting and 4 others to get in cuts. And considering they don't see inflation down to target until 2025, then that leaves 4 to 5 cuts very optimistic for the year. And that's the disparity we've got going on between what the ECB are suggesting and all these speakers and what the market is suggesting. How it all plays out, we'll have to wait and see. But I'm continuing to side with what the ECB say rather than what the market says. And the same goes for the Fed as well. How that's going to present in trading opportunities, I'm yet to decide, because it's not going that way as far as the markets are concerned. Kay, it's been a one-way flood of don't get too optimistic.
Yeah.
And no one is talking about early cuts.
No.
When is the market going to listen?
I got the impression it's already half listening, because we are in percentage-wise starting to reprice or to alleviate a bit the pressure on those yields. It's probably going to be a reaction if and when we break certain levels in yields. The markets will be forced to reprice more. But yeah, it's a bit of a global phenomenon here. I must say some of the markets are listening, because I think one of the reasons why the yen is so weak, for instance, is that one of the reasons is that the yields are holding us where the ECB, Fed, especially bonds, are starting to fight back against March expectations. And that is filtering through. If you look at stuff like, for instance, the German yields are a bit higher, US yields are a bit higher, and then you look at the yen crosses. They are a pretty docile follower, because we are not putting that much expectations anymore in the Bank of Japan before the new fiscal year over there. So I mean, it is filtering through in the markets, expressed in different ways. The other reason why yields are not really flying is, I reckon, that the market is still expecting very low growth, and inflation, as you showed and as we showed over the past month or so, inflation is a bit stubborn, but PPI is still ticking down. So that's all about soft landings and not needing to, very little stress as such in the system. So it all comes in various forms, the repricing. But yes, I mean, there's definitely some repricing going on. For instance, if you look at the short end, if they need to reprice, which is the closest one to the Fed funds, if you start to get above that 440 in the 2 years, I think then the market will really pay attention, to or is in the process of more repricing. So it takes different forms. And also, what is of interest is that we are again seeing quite a bit of funding needs from the US Treasury and other countries. And that also may help those yields to tick up. But if you look at the globe, and then if you look at the global picture, it's still one big trade, right? I mean, all yields are going, in the majors at least, all yields are going exactly in the same direction, because I'm looking at the differentials. Yes, they're hopping up and down a little bit, but really basically in the past few days remain unchanged.
Yeah, I mean, I might go as far as to say that perhaps yields have, they've been the Wild West really in the last couple of years in terms of pricing, repricing, and getting in games.
Hang on a minute.
Perhaps now they've returned to some sort of normality in terms of they're happy with what they think is going to happen with rates, because dollar yen ramping up to near 148, you would have thought that US yields would be up at 420 or something, and they're just not doing anything still. Really tight range, probably one of the quietest periods we've seen for quite some time. So maybe the bond market is finally calming down. It knows where it thinks rate cuts are, which is probably about 3 or 4. If you look at 2-year yields, we're sort of a whole percent off of the highs. So that's probably round about right for the Fed expectations of 3 cuts. So yeah, because it just seems that the last 2 days the dollar's been out on its own. It hasn't even been that much yen stuff going on there. It feels to me like it's been a lot of this has just been the dollar, and I don't know why. It's just the dollar that's doing this. If it's repricing Fed expectations, like you say, you'd expect yields to be following suit as well, but they don't really seem to be that much. So it's a bit of, I have to say, this new year has been a bit of a puzzle more than most New Years coming into it. I don't know if you feel the same way, mate.
Yeah, on the other, well, I don't know if it's only the dollar versus yen, because you look at the crosses, they're all higher. By the way, Jordan just commented on the Swiss franc that he said is now appreciating in real terms. It's stronger, need to take it into account. Frank, well, he's still happy about the franc appreciation pushing down Swiss inflation, and he says currently have adequate conditions which may change. So yeah, the Swiss got hit just smalls on the back of it. Maybe it's finally what I was expecting that's going to happen here.
Yeah, I hope so.
Right. No, back onto what you were saying. No, yeah, it's been a dollar theme, but I think the dollar theme is still a bit what's going on. There's been other factors as well, and geopolitics, and the stock market a bit lower, and yields coming up a little bit again. But there's quite a few things going on actually. If you look at the dollar strength is due to various reasons, I think.
Yeah.
And also a give back of what happened at the end of last year.
Yeah, that's true. That's very true.
Okay. Brent, by the way, the Swiss news, I've put it in our chat room, okay? I want to hear what you want to hear on Swiss. Yeah, I think, I mean, it's perhaps the start of a bit more, I may not say Swiss weakness, but at least correcting more of what it took over the past months or so. Yeah, I'm still in that camp anyway. Right.
Yeah. Cool. Right, let's get back to it because there's a few more bits and bobs
let's
to get
back
over
to what we were talking about
before we can even take a look at the prices. Right, data yesterday. Another wild ride in the data. We had US Empire Manufacturing coming in, absolute stinker, down 43.7. This one has been a bit wilder late, but that is wild beyond anyone's imaginations on that one. New orders came in at minus 49.4. It fell 38 points from minus 11.4 last month. Some of the other metrics weren't as volatile. Employment came in minus 6.9 versus minus 6.1 previously, so still negative reading on the employment front. Prices paid ticked up to 23.2 from 16.2. Expectations were up to 18.8, up 7 pips, and capex, which is investment, was up 10 points at 13.7. So some of the other underlying numbers not looking as bad, but those headline numbers looking pretty atrocious. Almost feels like there's some weather involvement in there. I don't know if some of those winter storms had hit by the time they did this survey. I haven't seen too much on that so far, but anyway, stinky numbers from that, which is going to put a bit of expectation into the next lot, which is the Philly Fed numbers to come. That's a second manufacturing, and then we start getting into the PMIs and stuff. Over in Canada, more sticky inflation. CPI was expected to come down it went up to 3.4% as expected. Then we've got all these 25 other different ways they like to count it. Pretty much all stayed sticky or went higher. Core, common, whatever you want to do it, medium, trimmed, haircuts, whatever you want to call them, all sticky, which may see Macklem taking a little bit of a hawkish slant next time we hear from him. He can tend to swing with the data, as we've seen before. We also got, well, after that, money markets, Canadian money markets only saw 34% chance of a rate cut in March, which was down from 46% from before the data. So less chance of March cuts by the BOC there. Fed's Waller was eagerly anticipated as something to watch for yesterday. He came out and said the data in the last few months is allowing the Fed to consider cutting the policy rate in 2024. When cuts begin, they should be methodical and careful. We can cut this year if inflation doesn't rebound. There's no reason to move as quickly or cut as rapidly as in the past. The timing of cuts will be up to deliberations of the FOMC. The Fed is very aware of the risk of over-tightening. He expects the Fed to think about slowing the pace of tapering the balance sheet sometime this year. Says 4% wage growth is a little high, but not by much. We also found out that his dot plots are right bang in the median expectations of 3 cuts. That's what he's going for. So Waller turned one could say dovish or unhawkish back in November, I think it was, and that got the market hopping and popping. That was amidst all the rate cut game that we were playing there. So some of these comments have seemed a bit hawkish. To me, he's covered every single base, okay, and some others agree with that too. He's been hawkish, he's been dovish, he's talked cuts, he's talked holding back a bit. But the market went up, went down, dollar went up, went down, and then when he'd finished, the dollar took off from that point. Google, so they're laying off hundreds of employees in its advertising sales team. Just another headline from one of the big tech companies talking about job cuts coming in. It's only talking hundreds, not thousands, but it's just a little bit of a snowball that's rolling at the moment amongst the tech firms. We've heard from several, Amazon in particular, cutting here, cutting there, in their Prime video unit, Audible unit, that sort of thing. Good news for the shutdown, the government shutdown. The spending bill has cleared the first Senate speed hump. That will now progress on to the next speed hump, and we'll see what comes of that. But by all intents and purposes, it looks like we're getting a good old can kick from that. Kay, got anything you want to add to all that lot?
Yeah, I mean, there's one thing that happened yesterday, but perhaps I'll talk about it when we look at the prices on everything that's been moving. I'm gonna show something in what's happening in the mix, for instance, which is pretty interesting. But no, I think you covered most of it. And Waller didn't take back much, but he didn't give anything extra, right? Yesterday, it was more like a bit on back a bit more onto the side. But he did say something interesting, in my opinion, and that was the dots were fairly priced at 3 cuts for this year, and I think that's what raised the market's antennas and why it continued to buy dollars yesterday. And on this on that New York Empire number, it looks a bit strange in a way, because it brings us back to 2020 pandemic levels. And I don't know, perhaps as you say, it's weather also related, but that looked like a pretty horrible one, and it got pretty quickly ignored by the markets, right? It's not your biggest data point either.
No, that's right. It's right. I mean, I wouldn't be surprised if you saw a similar sized reversal in that number next month. Certainly, if it comes in around about the same levels, then that does indicate that there's problems. But yeah, as bad as it looks, as stinky as it looks, you have to think maybe it's a bit of an outlier. And but we won't know till next month. Then we'll see what happens with the rest of the numbers. If the Philly Fed comes in okay, then the market probably won't pay much attention to it. And we've got to remember it's manufacturing, which isn't as big a sector as it used to be. Certainly not as big as services these days. But anyway, data is the data. Right, let's have a look at a few prices. I'll have a look at a couple because I know Kay will probably have a look at some as well. Cable has confirmed the range for now. Well, let's get onto the one where it's got me bits and pieces on. 126. We had a little toe tap underneath it, a little dip in the water underneath it, but it's held. And look at that. Nice big recovery, almost back up to 127. So the quid's still supported here. We've got a couple bit more pieces of data to come. Retail sales Thursday or Friday, maybe, if I can remember when it is. So that'll be another piece for the jigsaw. But it still looks like cable wants to sit in this range, and it's certainly looking a bit more stronger than euro dollar at the moment, hence why we're seeing euro sterling weakening. Now, I thought we might have seen this after the CPI data, but it's taken a bit longer to drag itself down. We've been mooching around this range. We have now broken those lows. We are knocking up against the next area of support. Stick it on that one might be a bit more clearer. So this 85, 60, 70 area has been a bit of an on-off support and resistance area. Again, not one I may look to trade, but just one of those watch levels where the price might do something. Certainly, if we get under there, we're going to head to the next support point, 85.50. And if it keeps going, we may even get a test down towards the bottom of the wider range at 85. So I'm still long this. I'm still interested in trying or adding back to my longs if we get a move down here. But I'm going to be pretty mindful of how strong the pound is going down there and what the data is between the Eurozone and the UK, because it may be that I may look to set up for a break trade of 85, 84, 80. If the pound is looking strong and keeping that strength. Aussie dollar is another one. I've just had a little feeler long. We've hit this. We got through the 50 fib. We got through all the support. Now we've hit this pretty strong zone, 65.40s down to 65.20s. I know people have got different levels there or thereabouts, but we've hit this zone, had a little nick into it, but we've bounced so far. So the support is holding for now. I've gone a little long against that level, actually at 39 I'm in, and I'm happy to play it down to the bottom of that zone, maybe down to the big figure in 61.8 fib if we go there, but I'll wait and see what the price action brings. So for now, the tech is doing its thing. We are finding a bit of resistance at this broken level now on the bounce, so that needs to be monitored, whether we're going to ping pong here and then it becomes a decision: do we break down or do we break back up? The big number above for me is 66.40. That's the big break point from all this action. So if we do rally, that's going to be a level I'm going to be watching, but there's plenty of other little bits and pieces in the way of that as well. Dollar yen I'm not touching. We knocked up against the 61.8 fib for a while and then we busted it, ran into trouble at the big figure. 148.40s is my next level above, and then it gets sticky as we get towards 149s, and obviously the big 150 is going to be a level as well. I'm still interested in shorting it. I don't know why I'm not longing it, but I'm still interested in shorting it. But I'm standing out the way for the moment. This is going too high, too fast for me to jump in front of the train. So I'm just going to let it go. Maybe see what happens over the BOJ. If we get a real big push up on that, I might have a little attempt at getting short once more. Okay, did you want to grab the screen for a bit then?
Yes, sure. I'm going to talk about relatively the same currencies, but there's one I would like to show first.
Yeah, just want to take Ali's question just before you start. It says, I'm a bit of a counter trend trader. Yes and no. I counter trend if I'm particularly doing a long-term trade, if I feel that that the market is wrong about something, or I expect something from central banks. Other than that, the only reason I'm really counter trend is just trading the levels, like Aussie dollar. There's a big level on my chart. It's been there for ages. Talked about it long enough. It is going against the trend, but it's a level I'm happy to trade. I won't trade every level just to counter trend. It's more a levels trade than whether it's counter or going with the trend. Anyway, sorry, mate. Why don't you crack on?
Yeah, no problem. First of all, I want to show something here which happened yesterday in the dollar mix, and a few days or a few weeks back, there has been, and I've got to give credit where credit is due. There's been Citibank that came out saying that if we would get a Trump victory, there were two currencies that they would like to trade, and was the China and the Mexican peso. And then yesterday we had this Trump victory in Iowa, and it seems that whether it's Citi and their suit have been on the ball, or the market really taking notice of the combination, even if it's not the official U.S. election, even if Lai in Taiwan only won with a certain percentage, whatever, but the market seems to have taken notice of it in risk. And the emerging markets, and especially the mix, has lost a lot of money. And I think some of people in the market who were a bit relaxed about carry trades and stuff have been forced out of their positions. So this was the one that I was looking at yesterday, and I did cut my short Euro mix as well yesterday, because after a while I kind of recognized what the market was trying to do, and I think the market has a bit of nightmares about walls in Mexico, walls and stuff being rebuilt, coming back if Trump would win an election. So again, credit where credit is due. This is the move yesterday in MEX. So the market does, or has taken notice of this combination of Trump and Lai, and expressed the risk in the emerging markets. Dollar rand, by the way, also went on a bit of an explosive journey. But this one is one that is worth noticing, because not only technically, and I know the people in our room have played this, some people in our room have played this really well, where they were trying to pick bottoms here. They have succeeded in the end to find the bottom. Now we have reached a bit of a level here in dollar mix, and similar to when we had those prior shocks in Mexican peso, we will have to see if we start to break prior levels. Okay, it's still a while away, but anything between 1740 and 1755 on the dollar mix should be closely monitored, because if we start, because for now we've been consistently doing, after spikes, lower highs, right, in the medium term in the Mexican peso. So I really would like to draw your attention to this zone here. It's about 1% wide, but it's still an emerging market currency. If we start to find a top here close to this, call it 1740, 42, 43 zone again, that will again print a lower high, sorry, and then we can start to move back down. And by the way, if that was a bit of an inverted head and shoulder in the short term, the target has been met around 1735, and that's roughly where we are stabilizing right now. We will have to see what happens once New York comes in. But just to show our audience what may happen in case this is a bit of a sample of what we may get if Trump gets a victory later on in the year. So this is one, I guess, for the calendars, again, to write this down, what happened over that Iowa caucus election, okay? This is something that needs to be remembered when the US elections will come up. In turn, if we get a status quo or we get a democratic victory, it's probably going to take completely the other way again, all right? So but this is just a bit of a sample of what the market may do in case of a Trump election also. Yeah, and this is where I cut the rest of my euro mix. Then I was short from around here, bought some back on the way back down, and then I cut the rest yesterday because it looked a little bit too explosive, and that's what we've got as well. So if we stay above, perhaps it's already very close, around 1880, 1878, and that's already worth monitoring for what's going to happen with this pair. If we start to fail again, then I reckon we are going to simply come back to where we left it before, somewhere in the middle here around 1860. Now, yeah, yesterday I tried this Aussie around here, but I very quickly let it go when the market didn't bounce on the back of Waller. But the interesting one is that I've already got a small support zone here, bit of a trend line here, where we actually tagged it earlier this morning on the Aussie. Around 65.35. So that is the first level that I am watching there. And then the next one, of course, is 65. The figure, everybody's watching that in our room as well. If you want to catch a knife, if you think that the dollar has done enough, and you want to catch a knife here, look at this 64.80, which is the, what is it, 23.6% of this move lower here, which is hanging around 64.80. So if you want to have like reduced or defined also risk, I'd say if it goes back below 64.80, it's probably bad news, and we'll be trading in the lower 64s. Sorry for me coming over a little tentative, but I've hurt my back this morning and I don't know why. Right, I'm going to have a look at this euro sterling, and I know Ryan already spoke about it, but this is the box that we've been trading it for since the start of the month. I suspect that there are really good range traders at play. There might be something big, somebody trading a big option also, and constantly selling around 86.20 and then buying back around 85.80. We are trying to break out of the box, but I would say that we are not going to really leave the magnetic field of 86 before we really start to go below 85.70, which was a low here, and then here the 85.65. If it goes below there, then I think we are probably going to be relatively rapidly trading 85.80. And this is one that I have to thank Simon for. This is one that he identified this morning in our room as well. And if that would, this is ABCD, if that would come to materialize, look where the target is. It's again around 85 the figure, and I think 85 the figure is really going to be a big level. And that brings me back to what Ryan was saying. Perhaps if we get 85 the figure break, we could possibly see a quick run down to 83s, but we still have to break, and we even have to break loose of this bigger magnetic field. And if you look at it, it actually probably already started at really early December, where we started to have those offers coming in around 86.30, and then bringing it down to 86.80, and then we started to really trade around it. Really, I'm still short Ali, by the way, and I've added again this morning. I did cut some really smalls, but I am still short. I think there's still enough divergence between the UK and the EU for this to at least go and test 85.5 again. We will see what happens. For now, it's still a very slow grind. That is it. And then, okay, I have to show it, right? Because Jordan did comment. Euro Swiss is the first one. We are trying to break this little shorter term trend line here, okay? So Jordan just said, and I repeat, let's see if I can find it back. So he said, Swiss franc is now appreciating in real terms. Franc is now stronger. We need to take it into account. So The franc appreciation pushes down Swiss inflation, and we currently have adequate conditions that may change. So it's a bit of a saying that they are happy where they are right now, which is something that I was waiting for on the Swiss franc to see if we could get some further setback on the Swiss franc. But there is this line about that may change, which is likely going to keep the market on their toes. We don't know any of their levels, but I would expect that if Euro Swiss moves back into, for a starter, perhaps those high 95s into the 96 zone, which is the downwards channel top. Perhaps he may already say like, all right, guys, don't forget that we are two-way in this market, and that may be already a top. I would argue though that, and that it has been my play as well in the dollar Swiss options, that there is room to correct, right? There is room to correct. And so we've broken above 85.5. I would say that if we get a retest there, we have to have a close look at it, because I think it may retest and then go higher. We have a few levels here on the intradays or coming up. 86, 65, 80 to reckon with, but I think that it's, well, it wouldn't be a theft if we get back up to mid 87s towards 88, the figure with this 88, low 88s towards 88.20 being a bit of the magic level where we stopped before, okay? So I'm still of the opinion that we could move a bit higher here in various Swiss pairs. Okay, that's for the Swiss franc. What else? Yeah, perhaps that dollar CAD is continuing to push on, right? It hasn't looked back. We are now through 135. Well, an extra layer on there. We are approaching the 50% of this moved lower from 139 down to 131 3/4. The 50% is really not far from here. And if that goes, then we will be talking about those 136s here. Looking at oil is not able to keep a beat, okay? It's back down. So I think that unless the dollar starts to change direction, there is a possibility that this pushes up into at least those 136s. There is a possibility. Well, keep an eye on 134, 80, 95. If that goes back down, perhaps then people will look at it as a failure. But in the meantime, it's a pretty steady mover. Yeah, you covered the dollar yen, Ryan. I think that's enough then for today, right?
Yeah, thank you very much, mate, for all that. What have we got coming up today? US retail sales is the next item on the list for us to get our teeth stuck into. Sales expected to come in a measly 0.1%. Core sales a measly 0.2%. We are in obviously the holiday numbers here. Oh, I'm looking at Brazil. I want to talk about the real ones. Where are we? There we go. Let's start again. Retail sales 0.4% expected. We don't care too much about it.
You're not sharing your screen.
Oh, I'm not even showing my screen. Oh, bloody hell. Right. There we go. Can you see that all right?
Yeah.
Cool. Right. Let's start again. Retail sales are coming up in the US later on. 0.4% expected from that. So not hugely hot numbers from that. These are December numbers, so part of that all-important holiday period. I'm just looking at some of the numbers that on there. Ex-autos are expected in at 0.2%, and the control group expected at 0.2%. There's no expectations on this calendar. So a lot of 0 points going on here, which, as I said, because it's the holiday period, it could mean that the numbers are a bit more volatile this time of year. So anyway, that's going to decide probably the fate of the dollar. If we get a strong number, could be the make or break of dollar yen at 148 or not. Just keep an eye on some PPI data from Canada out as well. That's it from today. Watch out for all the rest of those central bank speakers. We shall see what waffle we get today, and we'll talk about it tomorrow. Trade well over all the data. Thank you very much, K-Man, as always, for your input, and we will see you all bright and breezy tomorrow.
Cheers, guys.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.